Welcome. This is Power Trading Radio Live. Power Trading Radio Live, fueled by Online Trading Academy. For more information on the show, visit us online at powertradingradio.com. Now, here's your host, Merlin Rothfeld.
Hello, everybody. Welcome to Power Trading Radio. It is your weekend edition. Another week down in the books. We've got the Ambassador of Opportunity, John O'Donnell, here in studio with us. John, welcome back.
Thank you, Merlin. Good to be here.
I got to say you were wrong. Just love saying it. Just boom. There, John was wrong.
The Vikings?
Vikings.
Well, I have to say you were right. Okay. Niners.
Wait, TJ, record that and loop it, and let's just play that. You were right. You were right. You were right. I want to see that one looped.
Matter of fact, we could replace that segment with your red boots with that segment.
Could we please do that? Because those red boots are...
And
back when I was an exotic dancer, those are the boots I used to wear. All right, well, it's been a pretty crazy ride for the opening month, really, or actually the last few months for the S&P 500 markets at all-time highs. I've got the opportunity for all of you to ask questions today. As you know, John O'Donnell and I usually for our weekend edition, we go down a lot of different rabbit holes. And if you would like us to check out one of yours, let us know what it is. Send it on in at powertradingradio.com, or you can go to our YouTube channels, broadcasting under Online Trading Academy's YouTube page, as well as Power Trading Radio's YouTube page, and I will go and say a shout out to those that are there. Usually Fridays are kind of a quiet time out there, so I see Paul and Chadsbury. You're the guys that don't feel bad. Oh, so Paul is commiserating with you. He's a Vikings fan as well.
well, Skull.
Yeah. Well, I'm hoping you guys are Packers fans this weekend because I'd like you to be wrong twice because my Niners got to win. All right. Send those questions in if you have them. And again, Paul and Chadsbury, it sounds like we're there for you guys and the other dozen or so that are lurking in the shadows. Feel free to chat in today. I encourage you guys always to send in questions for the show so I have some time to prep. Lo and behold, thank you, Dorian and Tom. You sent these ones in, so I actually had some time to prep for those. Dorian says, what is the data telling you about the housing market? And so I had my team do a little bit of research and bring up some charts. Now, of course, we could all make the opinion, actually not opinion, it's a statement of fact that there are some areas where the real estate markets are looking very, very good, and others where the real estate markets are not looking so hot. And that will always be the case. It's like saying which market sector is doing the best. Well, there's always going to be a hot and a cold one. But overall, what is the pulse of it? You know, we've been talking about this rather extended housing market, right, John? You think we're a little bit long in the tooth?
Well, it certainly looks that way. If let's take a look at some of the data, I think there's still rather bullish, buoyant sentiment out there for housing. Mortgage money's available.
Cheap, too.
Yeah.
I mean, these rates keep dropping.
On a relative basis. And so, you know, what's to be bearish about?
Well, let's look at
and by the way, more jobs. We've got more
Right.
employment. If you got more jobs, people probably have a better, or probably more credit worthy and have the flexibility of servicing a mortgage. So, you know.
Before I go show this chart, which I really want to show, it's great. You said it's creating more jobs. And it's interesting to me that is there a point, I've never experienced this because I didn't really study economic data this far back, but is there a point where you can say, you know what, there isn't enough employees, potential employees, to help fuel further economic growth? Almost like peak jobs, right? They said 5.5% was full employment. Now we're sub 4. When are we going to get to 2, 1? I mean,
I think there's a problem out there. There are certain sectors where there's a skills deficit. Certain jobs require certain skills. Are you with me?
Yep.
And there are certain, for instance, there's a tremendous shortage of welders in the United States. We haven't been educating welders, and we've had a generation of welders turn over. It's a very stressful job. And right now, welders are getting paid substantial premium to what would be considered minimum wage. So there's always going to be a skills shortage in certain sectors.
I'm talking overall labor. Like when you look at the employment numbers, we kept dropping and dropping and dropping from over 10% to now.
See, that gets down to labor at what price?
Right.
You see what I'm saying?
Yep, absolutely.
I mean, so if we're going to continue to move the minimum wage law up state by state, doesn't look like it's going to be a national referendum, but if we move it up state by state, there are some states that have tried it and have been successful with it. There are some other states that have tried it and rolled it back that haven't been real successful with it because it does cannibalize that job opportunity for a person who's just kind of first getting started, because whatever the wage rate is, they have to give the employer more output than what the wage is per hour.
Right.
And so there's always going to be a certain group of people that aren't going to get through that.
Someone will always be left behind. Okay, so a lot of you have been sending in power blasts over the past few months talking about how the housing market is super extended, it's going to crash, it's a bubble. That's all a matter of opinion, okay? We can look at the price charts and see certainly some significant appreciation in the price of homes in various demographics. But let's go look at an interesting chart put out by the National Association of Home Builders. Now, I know this is biased because home builders obviously are looking out for their own self-interest. Now, the way this one works is really you're looking at above 50 means that there's extreme optimism, or there's optimism. Below 50 would mean that there's pessimism. So I had my team go back into 2003 just so you guys can see for reference what happened when we peaked. Now, remember, our markets really started to crash in late 2007, early 2008. But what you're looking at here is that NAHB, National Association of Home Builders Housing Market Index, what their opinions were. Look where we're at right now. We are looking extremely strong, albeit I believe it's a little bit extended, but it does show aggressive optimism on the part of home builders.
Higher highs?
Higher highs, higher lows. Now you can be rest assured that the NAHB, the housing home builders, Toll Brothers, Lennar, KB Homes, have a ton of teams of highly analytical people researching these markets, getting a pulse as to what the market is doing. And why don't you look at something for reference? Let's take a look at the S&P overlapping the NAHB Housing Market Index, okay? So I'm going to have TJ slide that one on there. If you wouldn't mind, TJ, bring that one up for us. There you go. Notice, of course, the S&P 500, that's what we're looking at chart-wise, bottomed in 2009. That was convenient right at the time that the NAHB Housing Market Index was below 10, which is incredibly bearish. However, I want you to notice on something else. This, to me, is really important, why this is, to me, leading to a much higher housing market. Maybe not much higher, but certainly a higher housing market. Here's why. If you look at this vertical red line that TJ just drew on the chart, that's when the NAHB members or those that were doing the survey all of a sudden started to lose their optimism. That was in middle of 2005. But when did the market start to peak? That was middle of 2007. So there was a 2-year lag time where home builders, for whatever reason, whether it was a credit crisis, whether it was all this subprime lending, looked out in the future and said, you know what? We're not optimistic. We're actually going to start cutting back our construction of homes or our forecast for construction of homes. And to me, that was rather interesting because that was a leading indicator back then. Now, will that be a leading indicator like it was? Will we see that going forward? Right now, I don't really see that. You saw a sell-off in 2018 right over here on the right-hand side where the markets were pretty lockstep with those expectations from the NAHB. But I think that this is one piece of data that actually supports a much more bullish housing market going forward. And I know it seems almost impossible to believe, but yeah, I do think you'll see some upside out there. Keep in mind that if you start to see this roll over aggressively like you did in 2018 or maybe back into 2005 and 6, then that might be a warning sign for you. It doesn't mean that this thing is over, but we're supposed to use this data to help us formulate an opinion about what might happen with these markets going forward, an anticipatory tool, and I think this is a great one for that.
Yeah, I think it makes sense. Now, probably the best way to participate in this bullish sentiment is the ETF XHB.
Okay.
I don't know if you can pull up that
TJ can do anything
platform, but if we could pull up XHB,
that
is the ETF, and we should probably see a corresponding chart that looks remarkably similar.
Yeah, well, pretty aggressive. I mean, this is, certainly going back to those lows in 2009. Yeah, that's exactly what it looks like. Super, super sharp move to the upside. Let's go show you a couple other pieces of data, which, again, I think support this. Remember, when we're looking at housing starts and new construction, this brings in a lot of other jobs. It's not just the home itself. There's all the lumber, there's all the plumbing, there's all the labor, there's concrete, all the materials. So
all the furniture?
All the furniture, sure. Here is the housing starts going back to the same period of time. Now, remember, we talked about it peaking kind of mid-2005, and that's when the home builders were basically saying, nah, we're not optimistic. They scaled back significantly. Of course, you can see from 2009, they've been progressively, they're building more and more and more, not as aggressive as the sell-off, but growing back up there. And today's number that came out in housing starts was phenomenal. They were expecting, I think, 140. We came out at 161, which means a lot of new starts. So this is obviously great, and you guys know that I'm a fan of the trend is your friend to the bend at the end. So that is looking great for further upside movement. And finally, that's the earnings one. So those are the two I wanted to kind of bring up there. The other piece that's noteworthy here, and I think that this goes to Orlando's question on Power Trading Radio's YouTube channel. He says, well, what will any further Fed rate cuts in 2020 do for housing and mortgage rates? Well, remember, if you're going to cut, that's generally going to have an impact on things like the 10-year. So if they cut rates even further, then we could see the 10-year go from 183 back down to 150. If it goes to 150, that means that it's going to be cheaper for more people to have access to this capital, or the capital they get is cheaper. It also means that, people like myself who are in very, very low interest rate loans, I may actually go and refinance and then take that, maybe pull out a little bit more and use that capital to buy something else. So using a bit of market leverage there. So I think that if you do see rate cuts and we get that 10-year to drop sub 150, I think it's fantastic for the housing market going forward.
Yeah, but that's a big if. Because,
it is a big if.
Because the Fed has been signaling that they're done, that there's going to be no more rate cuts this year. And the market, I think, is taking that to heart. And so what is the probability of more rate cuts? I think it's relatively modest.
You want to know it? No, well, TJ has the CME chart right here. So you want to know let's go out. Let's go to December, TJ. This is the CME Fed Funds Futures Watch tool. So we'll go to December 16th of 2020 to give you guys an idea of what it might look like in December. Right now we're at 1.5 to 1.75 for the Fed Funds. So TJ, bring this chart up here, and here's what we have cooking for December. It pretty much looks like the Fed is full of it and not being truthful, because the market has priced in at least a 25 basis point cut. Right? You can see that there's a 39% chance we'll stay where we're at by December. 36 plus 14 plus 3 plus 0.3. I can't add it off in my head right now, but you're looking at probably, let's see, that's 50, 53, over a 50% chance that we are going to have a rate cut of at least 25 basis points. Okay. So there you go. And that would be, I think, very good for the markets. Again, cheap money means more fuel for this economy going forward. Yeah?
Okay. Yeah, I got it.
There you go. All right. So there's one. Let's see other questions out there. I saw a few more coming in here. What's included in phase 2 of the trade? Oh, yeah. Don't know. I haven't gotten there yet. You get some funny comments going on. Terry in Arizona says Arizona's booming. Yes. And again, there's some spots that are doing great. Others are doing absolutely terrible. So what's interesting is not just the housing prices, but what we're seeing with certain demographics. Millennials, for example, are leaving California, and they're moving to places like Texas, like Washington, and other states where they might get more bang for their buck. Understandably so, and that obviously is going to have an impact on these housing market prices.
There's also a lot of people leaving New York, New Jersey, Connecticut. They're moving to Florida, Texas. They're voting with their feet and moving away from high taxing areas to lower taxing areas. And I think that
can't say as a blame them. I mean, look, we're California.
Can't blame them.
Killed out here in taxes, but I do like my sunshine.
Well, we do too, but at what price?
True. I know my friends in Texas are going, yeah, we got sunshine too. We just don't have the sales.
Yeah, intermingled with your ice storms. Okay.
Well, it's always a trade-off, John, because, in Texas you don't have state income tax, but you also pay through the teeth for property taxes.
That's
so
correct.
They're going to get you one way or another. All right, let's take a quick break. We come back. I had another great question from Tom, which was, what's your biggest surprise from this earnings season so far? Look, from my perspective, for all intents and purposes, this is really like the first week of earnings season. But I do have some takeaways which I find very interesting, and I think pose some real challenges for April and May of this year. So we'll take a quick break. John O'Donnell is our guest on the program today. If you have questions for John or myself, send them on in. PowerTradingRadio.com is a place to do that. Or you can join our discussions. Be friendly out there on our Online Trading Academy or Power Trading Radio YouTube channels. We'll be right back after a short break.
What if you knew the income strategies professional investors used? The strategies designed to generate active income from the financial markets. After all, no one's going to care more about your money than you.
I learned that I can be in control of my 401k.
I used to work for money. Now I have my money working for me.
With the right training and guidance, you can learn the skills to become a more confident investor and make your money work harder for you. Want to find out what's possible for you? You can, as long as you're willing to take the first step and call OTA today.
Call for your free tickets right now, and you'll also receive a free Professional Insiders kit loaded with lessons from some of our top instructors on topics like enhancing your retirement strategy, capital preservation, and income generation. The Professionals Insider Kit makes it so you can get started right now.
Call 888-304-8723 or visit us online at tradingacademy.com and schedule your free class today.
Click is something I wish I had when I started because it facilitates the learning process a lot quicker.
This is not about taking many trades, it's about taking the right trade.
It helps me save myself from myself. It's just a revolutionary educational tool. It propels you through the learning curve.
The biggest shock for me is the level of innovation that happens within the company, and it's continuing.
Is just perfect in this new century of trading.
Everyone's on the same side, and I think that's what I love about it more than anything else. Helping each other, supporting each other, all with the same objective. Again, wonderful.
There's no mountain high enough that the leaders in this organization won't climb for their students. They'll just never give up.
It can only help. It can only make one a better trader.
Gives you one of the most valuable things we all have, and that's time.
Welcome back to Power Trading Radio Live and your host, Merlin Rothfeld, with today's special guest.
Hello, everybody. Welcome back to Power Trading Radio. It is your weekend edition. We've got John O'Donnell here in the studio today with us. So again, if you have questions, feel free to send those on in at powertradingradio.com or on our YouTube channels. Question that came in, this is actually on Wednesday from Tom, but I figured it'd be a great one for the weekend, is what's your biggest surprise from this earnings season so far? Now, of course, from my perspective, I think we really kicked it off this week with some of the major banks, so I think it's a little bit too early to tell. But John, do you have any takeaways? Anything that you have noticed yet?
I agree with you. I mean, we're only in the second week of January. It's too early for that question. He needs to be asking that question more toward the end of the month. But I don't think we have enough data yet to have a lot of surprises.
Okay. So, Tom, here's my takeaway on that one. I've been watching the banks because I think you guys may remember a couple weeks ago I was saying, look, I think if the banks have just blowout earnings, if the banks have blowout earnings, it'll set the tone for the earnings season, which should be a very positive one, and that could boost things higher. Or if they miss significantly, that could also have the same inverse effect on the markets and potentially start us on a nice little retracement. Now, everyone except for Goldman Sachs has had phenomenal earnings. I mean, Morgan Stanley, JP Morgan, these guys crushed earnings season. We're talking record numbers never seen before. Goldman missed, and of course a lot of this has to do with trading revenues. Surprisingly, in reading through some of the statements, especially from Morgan Stanley and JP Morgan, a lot of their revenues were due to fixed income trading, were much, much higher. Of course, when you have this talk of negative yields around the world, I'm sure they had a lot more business going on as people wanted something with yield, and they were selling those to the clients. So I want to show you, this is my takeaway so far. And to me, this is a red flag. And it's not the doom and gloom piece, but take a peek at this. This is Morgan Stanley's earnings going back into Q1 of 2019. The little blue circles represents the consensus earnings per share estimates. Now, if you go back to Q1 of 2019, Morgan Stanley beat by 23 cents. Q2, they beat by 9. Q3, they beat by 16. Q4, they beat by 31 cents, and that's what came out this week. What's interesting is, notice on the left-hand side how those blue circles are all trending down, right? All of a sudden, because of this, their forecast was amped up significantly. Look at the jump in earnings per share. It's huge. Now, again, who knows, maybe this has anticipation of share buybacks going in, but I find this to be a potential problem because while Morgan Stanley is on an uptrend with their earnings, that's a lofty goal, especially given what's going on in global markets. So to me, this is a scary one for the financials. Now that's Morgan Stanley. Take a peek at, who do we got next, TJ? JP Morgan. JP Morgan, those green dots, they've been beating earnings expectations, but it's trending down. And all of a sudden they have a huge jump up from their estimates of $2.35 to $2.74. That's a huge jump. And again, when they're lowering their forecast like they were in Q2, Q3, Q4 of last year, it's easier to jump that hurdle, right? If you're in a race or if you're in a pole vault event and you clear 5 feet, okay, I could probably go 5 feet, a couple inches. But what they've done is they just said, I'm going to go to 4 feet now. So it's easier for these firms to beat those hurdles. Well, all of a sudden in this picture, JP Morgan went from like 5 feet to 4 feet to 3 feet, and now they're up to 10 feet. To me, this is a huge challenge for these firms to meet this earnings expectation, and there's more to it. Here's Goldman Sachs. Goldman Sachs has 2 red circles. They've missed. Not only did they miss this previous one that happened, I believe they reported on Wednesday, they missed by 78 cents. That is a huge miss. Yet all of a sudden their analysts and financial markets expect them to earn $6.30 per share. So either I'm missing something in reading through these financial statements or anticipating market growth, or they're setting this bar way too high, which to me makes sense to think about April, especially that first week in April or second week in April, as a potential turning point for whatever market's going on. I just think that these goals have been raised way, way too high, earnings expectations.
Yeah, I get it.
Am I crazy, John?
No, I think those are great pictures.
All right, so anyway, there's my take on that one. Tom, we'll have to wait and see. The other one that I found really surprising, not really surprising, Alcoa, right? Alcoa was removed from the Dow Jones Industrial Average because it was just underperforming. TJ had a chart over here on break. We were looking at Alcoa. Bring that one back up if you would mind, TJ. Yeah, here's Alcoa. I mean, this is just ugly. You can see their earnings was just getting crushed. I know some of you have been asking about this as a potential buy. I'd be very careful with this one. I'm not a huge fan of it, although the analysts who have been raising their forecasts on almost every single security out there have a huge earnings beat, actually almost getting back up to, I think the expectations are like -1 cent and they're like -30 right now. So they're expecting a huge turnaround in Alcoa for the next quarter. So I'd be really shocked to see that, but you do have some demand levels coming into which may be a potential buying opportunity. All right, there we go.
Yep.
Let's see. Don Armour says, Merlin, what would you think about doing a leap option on XLK? You know, technology's been the piece that's been pushing this thing higher and higher. I know you guys will say, no, it's the Fed. And yes, you're right. The Fed is certainly the catalyst which has been vaulting this market higher. However, you look at this chart of technology, and it's much prettier than the S&P 500. This is a gorgeous chart. Technology has just been absolutely ripping. We'll go through to the monthly just to put this in perspective and why I wouldn't be buying leaps on this one. Would you think about doing a leap option on XLK? I would not. If anything, I might do a leap put. I just feel like there needs to be a correction. It's unhealthy to have a market run this far, this fast. And the longer that these things go like this, usually the more severe those corrections are. You saw a mediocre one back here in late 2019, but I don't think technology is going to continue to carry all the weight for the markets, and right now they're one of the best performing sectors out there. So I'm a little bit pessimistic about buying a leap right now, especially when it's at all-time highs. Don, if you were thinking about it, I might wait actually for a pullback in these markets to a more attractive demand level as opposed to just buying right now. There you go. Let's see, what other questions I got coming in through here? I got a lot of stuff. Gizmo. Yeah, Wells Fargo. Yeah, right. Gizmo says Wells Fargo sucked. Yeah, their earnings wasn't very good. But I think the bad one that I saw was Goldman Sachs. And we joke about that, right? We call them government Sachs. Because they've got connections in every political office around the world. You would think that Goldman would always be beating earnings, but they had a 78-cent shortfall this time. All right. You had a chart you wanted to look at earlier. What was that one? We had. Let me see. I think you actually.
Well, we were talking about the gross output.
Okay. Let's see if we have that one up here. I think we might actually have that gross output. Okay. So first, for viewers, explain gross output because some might be new and not know what this measurement is.
Well, this is the adjusted gross output versus GDP. And what gross output is a new indicator that was developed by the National Bureau of Economic Affairs. So it's an independent organization that measures the production side of the economy against the consumption side of the economy. The consumption side of the economy is the red chart in red, which in fact is GDP. Now, most of us have been led to believe that GDP is about $21 trillion. Let's round it off to $21 trillion. And we have been led to believe by the Keynesians that 72% of GDP is consumption. Well, it turns out to be a little misleading. Because when you take into consideration the production side of the economy, which GDP does not take into consideration, you get the blue line here. And that turns out to be the basically B2B side of the economy, business to business side of the economy, the wholesale side of the economy. And that turns out to be about $41 trillion. So if you take 41 trillion plus 21 trillion, you can see that we have a much bigger economy. And it turns out that GDP is only about 33% of the whole economic picture. And but right now, what this indicator is telling us in blue, which is a bit bullish on the hard right edge, is that probability for a recession in 2020 is quite low.
Yeah, okay.
Okay, and so this is kind of confirming bits of information that we looked at on your S&P chart and on your real estate chart here earlier today, Merlin.
You know, I have to, as you keep this chart up here, TJ, I have to, play devil's advocate here. And when I look at this, I know a lot of this stuff ends up being lagging indicators, not leading indicators. And, if we look at when the equity markets really started to tank, that was back here in Q4 of 2007, which the gross output indicator, as well as GDP, were still doing rather well above. Okay, there was one little blip down below it. And then things really fell apart. So I agree with you that right now both of these metrics are showing, decent. It's not showing amazing GDP or gross output, but it's showing growth. It's showing, right around 5%, which I think is pretty darn good in this market going forward. But how much reliance would you put on this as something to help you make that longer investment decision? I mean, is this something that we go off supply and demand, we go off our indicators, our rules, and we will either, go flat or go to cash, and then this becomes a confirming piece?
Well, first of all, to your point, there is a lagging period of time as to when this is published. And historically, there's been about a quarter of delay. It took the NBER that long to collect the data. However, they just announced this week that as of September of this year, 2020, they're going to report gross output at the same time they report GDP. So the data is not going to have a lag to it any longer. So I think going forward, it very well may be take on the capability and utility of being a leading indicator. But you're right, there is a lag to this. But it's good to see what the production side of the economy is going, because the Austrians and Keynesians have a totally different perspective on what drives economic growth. The Keynesians want to tell you it's consumption that drives economic growth, and the Austrians want to tell you, no, it's really production, that you have to produce first before you have the facility to consume anything. So, that this indicator is worthy of your consideration. If you want to keep your finger on the pulse of this particular indicator, just go to grossoutput.com and keep your eye on it. And as a matter of fact, there's a newsletter there you subscribe to at no charge, and they'll keep you up to snuff.
In looking at data like this, obviously, I made it a point last year to try to put in more charts here for you guys, just because sometimes I reference a piece of data and you go, well, who cares? I don't have a reference for it. Industrial production, as John was just pointing out, production obviously is a key to gross output. That number today actually came out significantly worse than expected. They were expecting it to go from 0.8% to 0, meaning no increase in industrial production month over month. Actually came out at negative 0.3%. So 1 point data by itself would kind of scare these stats, because it's saying, look, we're not seeing industrial production growth. Granted, if you look back over the past few years, there are many month over month periods where we get a negative industrial output. It's really about a trend in industrial output, and we haven't had any clear, strong areas of that. So I just wanted to run that number because I'm sure some of you are probably asking, well, industrial production is looking pretty darn good. Not today, not today. All right, let me see if I got any other quick questions here. If you guys have some, feel free to send those on in at Power Trading Radio. No. Unscalable says, have you guys heard that Apple's market cap just surpassed the entire continent of Australia? No, but wouldn't surprise me. I mean, look, Google as well. I mean, these were just some.
Google and Microsoft.
Yeah, we got the trillion club. Yeah. Let's see. There was one question that came in, and I thought this one was interesting. We always talk about trying to get rate of return and increase whatever alpha we can over S&P. We are also looking for, depending on which stage of life that you're in, if you're younger, you're probably going to be much more aggressive, and this wouldn't pertain to you. But if you're older, nearing retirement, John, you might be looking for a very safe place to put your capital without taking on too much risk. Lee sent in this question. This is, I think, on Monday or Tuesday. What are your thoughts on China online banks offering 6% for deposits?
Well, God bless them, and I'm sure they did that just to attract your money, but they're not going to get any of my money. I mean, I cannot believe that any American, regardless of the yield, would want to put money into a Chinese bank. I just can't. That is beyond me. Call me old school if you want, but no, I don't think I'd want to do that. Secondly, I'm sure your deposit will be denominated in Chinese yuan. And I'm not expecting the Chinese yuan to strengthen against the U.S. dollar anytime soon.
What about, okay, so he says, good luck to him, wouldn't put my money in China. What if it was a Mexican bank?
Well,
Canadian bank?
Well, what is the stability of the bank? What is the protection of my money? via the rule of law. If there's a dispute or if the bank becomes insolvent, how do I get whole? You know, in that circumstance.
Right.
Now, if you're talking about putting your money in a Swiss bank, that's a totally different story.
Is it? Is it? Oh, hold on. Is it too much of a challenge to go to China and find out where your money went, or go to a Swiss bank and try to find your money? To me, money could disappear no matter where it is.
Well, it can disappear, but it gets down to the integrity of the bank and the integrity of the legal system. You know, in Switzerland, banking being one of the very, very largest contributors to GDP in that whole country, if you've got some shady banking going on in Switzerland, the bank regulators are going to be all over that. I wouldn't have a problem putting my money in Canada. I'd put my money in Canada. Canada is some of the safest banks in the world. You know, so it's a matter of the legal system, and it's of the track record of the banking system in the country. No, I wouldn't necessarily want to put it in Mexico. Now, I guess there are people that do, but it's just not my cup of tea.
You know, I'll tell you right now, you can get on a CD, I think if you're looking at about a 12-month CD, you can get about 2.12%. Now, we talk about this in a lot of our classes, which is risk versus reward. If you're looking for safety, obviously a CD should be relatively safe. And to John's point, and I'm 100% with you, I would not, for Lee, there's no way on earth you would get me to put my money in a Chinese bank. I don't trust it. The government can just take my money like that, and I've got no recourse. And what am I going to do? Fly over there and start knocking on doors of banks that aren't there anymore and try to find my money?
No.
Forget it. However, I don't even think that you could buy into, I don't think that you could go and put your money in that Chinese bank and get 6%. I believe, if I'm correct here, that that's reserved for special clients, and it's reserved for people who have money. And the reason they're doing that is so that you don't take your money out of China and put it into other markets. They want you to keep your capital there. So they're basically rewarding the Chinese citizens, not necessarily Americans or foreigners, but Chinese citizens for keeping their money there. Remember, there's opportunity cost out there, and if they're going to give you 6%, it sounds really good, but I wouldn't do it. Now, to the other comments that were made here, which Brendan, I like it. It's the only safe place to put your money is gold. Even there, I would say that's not entirely true. Obviously, there is safety in knowing that gold's not going to go to zero, but then you have others who are saying, well, you can go to UGLD. Well, look, you don't even own gold. If you're in a derivative or an exchange-traded fund or exchange-traded note, you don't own it. So that, again, is its own set of risks. If you're talking about safety and knowing that I have something of tangible value, then Brendan, you're absolutely right. Let's go with physical bullion gold. I'll have some gold coins. I'll have some gold bullion. That type of stuff is, I would say, the safer place to put your money with regards to it being seized or disappearing, right? Because you could control it. You could own that. The issue there with putting your money into gold obviously becomes liquidity risk. If all of a sudden the world goes to hell in a handbasket and you're trying to walk around with gold coins to buy things, probably do you no real good. The other part is the security risk, right? Cash, I think, is dangerous. If you put it in anything else that's not insured or protected, your money could disappear. And look what happened in Cyprus. I mean, those poor guys all of a sudden devalue their money 50%. Our money could be devalued if it wasn't cash. However, we do have deposit insurance, SPIC, FDIC insurance as well to help as Americans. I don't know if China affords any of those sorts of protection. So Lee, wouldn't touch it with a 10-foot pole. I would leave China all alone and just wave at their 6%. And let's find another way that we can use these markets to generate a greater rate of return.
Yeah, I mean, it's not about the rate of return. It's the return of the principal of your capital. It isn't just what is my rate of interest. It's what is the safety of my capital. When I need to get my capital, how do I know it's safe? That's the key consideration. If you put it in gold, you still have price volatility risk.
Sure.
So there's no free lunch. As a matter of fact, but I would certainly, if I wanted to have international banking exposure for some reason, I'd take a hard look at Canada. There's some great banks in Canada.
All right, there are. Our neighbors to the north.
And by the way, many of them trade publicly traded if you want to own some of them.
There you go. Got to most of our questions. I didn't see anything come through on Power Blast. Are you doing anything this weekend? Doing any teaching, traveling?
No, not this weekend. But I am going to be doing a couple of lectures in our classes here in Irvine next week.
Nice.
I'm surprised we didn't have anybody bring up what happened with the trade agreement, Merlin. I wanted to get your input. What do you think about the trade agreement there? Phase 1 that we signed here, what was it, on Wednesday?
Whatever. I think it's all part of the dog and pony show. I'm not that excited about it. So.
Well, if you parse it, in my opinion, I mean, I'll give you a short opinion on it, which is basically $200 billion from Chinese have committed to buy goods from America, most of it agricultural goods. That's $100 billion a year. The Fed has been repoing $100 billion a month. So let's compare $100 billion a month to $100 billion a year of purchase of soybeans or whatever they're going to buy in ag production. But here's the problem. In a $21 trillion economy, that's still a very small percentage. I think the greatest is this. If it is in fact a legitimate phase one, and let's give them the benefit of the doubt, they're going to be people of their word, and they're going to keep their word. Both sides don't end up reneging on the agreement. Hopefully it'll stop the tariff escalation, because the tariff escalation program is tragic in my opinion. The AIER, the American Institute for Economic Research, came out with a report. You can go to AIER.org and read the report by their economists there. They estimate that the net cost to the American public to get this done was $46 billion. That's the net cost. And, you know, if that was the only net cost, I mean, if someone can really compute that, perhaps that was a bargain.
Maybe. Look, time will tell. We'll have to wait and see how it all pans out.
And by the, I'm rooting that they get to phase two, but we're already starting to get information that maybe phase two won't even really get going until after the election.
Do you think that a lot of the reason that this ended up getting signed, at least for phase one, was because the economic data now is just pointing clearly to what you had pointed out before this all even started, which was this is just going to pass on to the end users, the consumers are going to pay for it. And then the statistics are showing that.
Absolutely.
Do you think this is part of that? Like, okay.
Yeah, China didn't pay for it.
No, of course not.
We paid for it in a markup in finished goods, period. The American taxpayer paid for it.
All right. So John won't be doing any classes, workshops this weekend, but I'll tell you what, there are 48 physical brick and mortar online trading academies around the world. Most of them are going to have some classes this weekend, some introductory to market timing courses. If you'd like to know more information about those, or to take classes on futures, options, Forex, commodities, you name it, we've got classes all around the world. You can find out which center is closest to you by clicking that link that's showing up in social media right now. Simply type in your zip code. That'll tell you which one's closest to you. If you like the discussion today, give us a thumbs up out there. I am going to tell you about our economic calendar for Monday. I think that's actually the second part of it. We'll go back one more. So let's go to Monday, January 20th, just to give you guys a heads up of what's cooking. Not a lot happening for the U.S. markets, that's for sure. We've got a bank holiday on Monday. For the euro, they've got the Euro Group meetings and trade balance for Swiss franc. Japan has monetary policy statement. Then we go down to your earnings calendar, which is very boring, right? New Oriental Education, Logitech International, Enterprise Financial, and then First Defiance Financial. Nothing exciting. I'll tell you, there are some very big earnings announcements coming up later in the week, but we'll have to save those ones for next week. On the show, we're going to have Gabe Velasquez. Gabe is one of our kingpins with regards to community, just a real straight shooter out there with regards to financial markets. So looking forward to having Gabe Velasquez on the program. If you have questions, something specific, like Tom and Dorian and Lee as well sent in a bunch of great questions, send those on in at powertradingradio.com by clicking that button that says Power Blast so we can get them all prepped on the show. If you'd like to learn more about how you can use financial market education to change your financial future, click that link that's showing up in social media or the free class button at powertradingradio.com. Until then, happy trading, everybody. Have a fantastic weekend.
Peace.
We're out of here.